Good day, sir and classmates. Our topic is about financial planning and forecasting. Ms. Maureen Kuwalan will discuss financial forecasting and I will take financial planning. To better understand our topic, let us have first the introduction to financial planning and forecasting. Financial planning and forecasting is the estimation of value of a variable or set of variables at some future point. A forecasting exercise is usually carried out in order to provide an aid to decision making and planning in the future. Business forecasting is an estimate or prediction of future developments in business such as sales, expenditures, and profits. Given the wide swings in economic activity and the drastic effects these fluctuations can have on profit margins, business forecasting has emerged as one of the most important aspects of corporate planning. Forecasting has become an invaluable tool for business to anticipate economic trends and prepare themselves either to benefit from or to counteract them. Good business forecast can help business owners and managers adapt to a changing economy. It means financial planning and forecasting represents a blueprint of what a firm proposes to do in the future. A lack of effective long-range planning is a commonly cited reason for a financial distress and failure. Financial planning establishes guidelines for change and growth in a firm. It focuses on the big picture, which means that it is concerned with the major elements of a firm's financial and investment policies without dealing with the individual components of those policies in detail. So let's go with the discussion of financial planning. First, let us define what is financial planning. Financial planning is the process of estimating the capital required and determining its competition. It is the process of framing financial policies in relation to procurement, investment, and administration of funds of an enterprise. Financial planning is a continuous process of directing and allocating financial resources to meet strategic goals and objectives. The output from financial planning takes the form of budgets. Financial planning formulates the way in which financial goals are to be achieved. A financial plan is thus a statement of what is to be done in the future. Many decisions have a long lead time, which means they take a long time to implement. In an uncertain world, this requires that decisions made far in advance of their implementation. For instance, if a firm wants to build a factory in 2024, it might have to begin lining up contractors and financing in 2022 or even earlier. The growth as financial management goal. The appropriate goal for financial manager is increasing the market value of owner's equity and not just growth by itself. Growth may thus be a desirable consequence of good decision making, but it is not an end unto itself. However, while growth rate is used in the planning process, it is considered a convenient means of summarizing various aspects of a firm's financial and investment policies. There are also perspectives of financial planning. First dimension of the planning process is the planning horizon that must be established. Planning horizon refers to the amount of time an organization will look into the future when preparing a particular plan. The short run planning usually covers the coming 12 months, while financial planning over the long run takes to be 2 to 5 years. The second dimension of the planning process that needs to be determined is the level of aggregation. Aggregation involves the determination of all of the individual projects together with the investment required that the firm will undertake and adding up these investment proposals to determine the total needed investment, which is treated as one big project. Due to the amount of time spent in examining the different scenarios and variables that will eventually become the basis for a company's financial plan, it seems reasonable to ask what the planning process will accomplish. Thus, we have the benefits of financial planning. First, provides a rational way of planning or alternatives. The financial plan allows the firm to develop, analyze, and compare many different business scenarios in an organized and consistent way. Various investment and financing options can be explored, and their impact on the firm's shareholders can be evaluated. Questions concerning the firm's future lines of business and optimal financing arrangements are addressed. Second, interactions or linkages between investment proposals are carefully examined. The financial plan enables the proponents to show explicitly the linkages between investment proposals for the different operating activities of the firm and its available financing choices. For example, if the firm is planning on expanding or undertaking new investments and projects, all other relevant variables such as source, terms, and timing of financing are thoroughly examined. Third, possible problems related to the proposal projects or identified actions to address them are studied. Financial planning should identify what may happen to the firm if different events take place. Specifically, it should address what actions the firm will take if expectations do not materialize, and more generally, if assumptions made today about the future are seriously in error. Thus, one objective of financial planning is to avoid surprises and develop contingency plans. Fourth benefit is the feasibility and internal consistency are ensured. Financial planning is a way of verifying that the goals and plans made for specific areas of a firm's operations are feasible and internally consistent. The financial plan makes explicit the linkages between different aspects of a firm's business, such as the market share, return on equity, financial leverages, and so on. It also imposes a unified structure for reconciling goals and objectives. Last, managers are forced to think about goals and establish priorities. Through financial planning, directions that the firm would take are established. Risks are calculated and educated alternative courses of actions are considered thoroughly. So those are the benefits of financial planning. Let's go with the objectives of financial planning. First, determining capital requirements. This will depend upon factors like cost of current and fixed assets, promotional expenses, and long-range planning. Capital requirements have to be looked with both aspects, the short-term and also the long-term requirements. Next, determining capital structure. The capital structure is the composition of capital, the relative kind and promotion of capital required in the business. This includes decisions of debt, equity ratio, both short-term and long-term. Framing financial policies with regards to cash control, lending, borrowings, and etc. Lastly, a finance manager ensures that the scarce financial resources are maximally utilized in the best possible manner, at least cost in order to get maximum returns on investment. So those are the objectives of financial planning. Let us have the importance of financial planning. Financial planning is process of framing objectives, policies, procedures, programs, and budgets regarding the financial activities of a concerned firm. First importance of financial planning is adequate funds have to be ensured. Financial planning helps in ensuring a reasonable balance between outflow and inflow of funds so that stability is maintained. Financial planning ensures that the suppliers of funds are easily investing in companies which exercise financial planning. Financial planning helps in making growth and expansion programs which helps in long-run survival of the company. Financial planning reduces uncertainties with regards to changing market trends which can be faced easily through enough funds. Financial planning helps in reducing the uncertainties which can be a hindrance to growth of the company. This helps in ensuring stability and profitability in concern. Business financial planning. The business world is an ever-changing environment. Company executives must continuously evaluate operations and goals to determine if the company is on the right track to success. Financial planning is a tool that companies use to create, implement, and evaluate short-term and long-term goals. It allows executives to use internal and external financial information along with other relevant market data to determine business strategy. As a company builds its financial plan, three important issues must be considered. First, how much money the company will need to get from external sources in the future. Second, how changes in operations within the company will affect its overall value. And lastly, how employee compensation plans will affect future business. Let us have financial planning models. So what is financial modeling? Financial modeling is the process of creating a summary of a company's expenses and earnings in the form of a spreadsheet or the Excel that can be used to calculate the impact of a future event or decision. There are three key takeaways in financial modeling. Financial modeling is a representation in numbers of some or all aspects of a company's operations. Financial models are used to estimate the valuation of a business or to compare businesses to their peers in the industry. Various models exist that may produce different results. A model is also only as good as the inputs and assumptions that go into it. So in financial planning process will differ from firm to firm, just as companies differ in size and products. However, a basic financial planning model will have the following common elements. First is the economic environment assumptions that describe the economy, market sector, and other external factors. Second, the sales forecast that drives a financial planning model. The pro forma financial statement that provides an ideal financial projection. And also the asset requirements that provides information about what is needed to drive sales growth. The financial requirements that details debt and dividend information. And lastly, the additional funds needed. This is a projected figure that a company could use to fund the strategies presented in the model. So let's go one by one with the financial planning model elements. First, the economic environment assumptions. The plan will have to state explicitly the economic environment in which the firm expects to reside over the life of the plan. Among the more important economic assumptions that will have to be made are the inflation rates, level of interest rates, and the firm's tax rate. Financial planning process will in the in the economic assumptions are assumptions that a company make about the general market environment, specifically the environment it plans to operate during the period of its financial plan. Businesses try to predict what the business environment will be like and how it will affect their ability to generate the profits. For sales forecast, a sales forecast is a prediction of future sales revenue. So the planning will focus on projected future sales and the assets and financing needed to support those sales. The purpose of sales forecasting is to provide information that you can use to make intelligent business decisions. Sales forecasting is an integral part of business management. Without a solid idea of what your future sales are going to be, you can't manage your inventory or your cash flows or the plan for growth. The pro forma statements, a financial plan will have a forecast statement of financial position, income statement, statement of cash flows, and statement of stockholders' equity. These are called pro forma or projected statements, which will summarize the different events projected for the future. Next is the asset requirements. The financial plan will describe projected capital spending. So at a minimum, the projected statement of financial position will contain changes in total fixed assets and net working capital. These changes are effectively the firm's total capital budget. This means that the minimum amount one must invest in order to participate in the activity. Next is the financial requirements. This part of the plan should discuss dividend policy and debt policy. Firms will expect to raise cash by selling new shares of stock or by borrowing. The plan will have to consider what kinds of securities have to be sold and what methods of issuances are most appropriate. Lastly is the additional funds needed or the EFN. Additional funds needed is the amount of money a company must raise from external sources to finance the increase in assets required to support increased level of sales. Additional funds needed is also called the external financing needed. So after the firm has a sales forecast and an estimate of the required spending on assets, some amount of new financing will often be necessary because projected total assets will exceed projected total liabilities and equity. In other words, the statement of financial position will no longer balance. Additional funds needed must be selected to cover all projected capital spending and thereby bring the statement of financial position into balance. So those are the elements of a financial planning model. Now, let us have the 10 types of financial planning models. So these are the most common types of financial planning models that are used by the firms, different firms. We have the three-statement model. A three-statement model is a type of financial modeling which connects three key financial statements like the income statement, balance sheet, and cash flow statement and prepares a dynamically connected one single financial model which is used as the base of complex financial models like leverage buyout, discounted cash flow, merger models, and other financial models. Discounted cash flow model. DCF is a valuation method used to estimate the value of an investment based on its expected future cash flows. DCF analysis attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. The merger model or the M&A. A merger model is an analysis representing the combination of two companies that come together through an M&A process. A merger is the combination of two companies under a mutual agreement to form a consolidated entity. An acquisition occurs when one company proposes to offer cash or its shares to acquire another company. The initial public offering or the IPO model. This refers to the process of offering shares of a private corporation to the public in a new stock issuance. Public share issuance allows a company to raise capital from public investors. The transition from a private to a public company can be an important time for a private investors to fully realize gains from their investment, as it typically includes share premiums for current private investors. The leverage buyout model. An LBO model is a financial tool typically built in Excel or the Microsoft Excel to evaluate a leverage buyout transaction, which is the acquisition of a company that is funded using a significant amount of debt. Both the assets of a company being acquired and those of the acquiring company are used as collateral for the financing. Sum of the parts model is a process of valuing a company by determining what its aggregate divisions would be worth if they were spun off or acquired by another company. Consolidation model. A consolidation model is constructed by combining the financial results of multiple business units into one single model. Typically, the first worksheet of the model is a summary of consolidation view that shows the highest level figures. In the form of tables or graphs or charts, other tabs in the model display financial data by departments, business units, or product lines by years, quarters, or months. Budget model. This is used to model finance for professionals in financial planning and analysis to get the budget together for the coming years. Budget models are typically designed to be based on monthly or quarterly figures and focus heavily on the income statement. Forecasting model. This type is also used in financial planning analysis to build a forecast that compares to the budget model. Sometimes the budget and forecast models are one combined workbook, and sometimes they are totally separate. Last is the option pricing model. Option pricing theory estimates a value of an options contract by assigning a price, known as a premium, based on the calculated probability that the contract will finish in the money at expiration. We do note that the overall goal of financial planning is to integrate tax, insurance, and investment planning into a comprehensive plan that helps the organization to strategically maximize their assets to reach their financial goals. And to end my report, let us remember Alan Lackane said, planning is bringing the future into the present so that you can do something about it now. So that would be all. Thank you so much. And these are my references.